Welcome to the Law Firm Owner Tax and Money Podcast. I'm Megan Robin, a California tax attorney, and I help law firm owners save money on taxes and keep their personal and business finances on track. It is the end of the year, pumpkin spice lattes, Christmas trees, and Halloween stuff in the stores at the same time. And so charitable giving is a big topic I'm thinking about right now as we come into the holidays and we come into year-end tax planning. Today, I want to talk about charitable giving from a tax perspective. There were some big changes with the new Trump tax bill that passed in 2025. I want to talk to you about how these new tax rules work, how to get the most out of your charitable giving without falling for some common myths that surround this topic, as well as the effect of giving through your business versus giving personally. Let's start with what's new in 2026. Starting in 2026, even if you don't itemize, you can deduct up to $1,000 in cash gifts if you file single and up to $2,000 if married filing jointly. This is a big deal. This means that people who normally would not get a deduction for their small gifts can get one. It's a modest tax break, but it's fun and hopefully encourages some giving on smaller scales from people who might not otherwise benefit from the gifts they're already giving but not getting a tax break for. For those of you who want to give large amounts and you are itemizing, the rest of the podcast is going to talk about that, with the exception of a carve out for retirees and a carve out for businesses, which we will talk about. So let's start for those of you who are itemizing and want to give large gifts. For this year, for 2025, the old rules apply. So there's no floors and no caps. If you give $50,000, you get a $50,000 deduction. And depending on your tax bracket, the value of that deduction will change. So if you are in the 25% tax bracket, every dollar you deduct will save you about 25 cents in taxes. If you are in the 37% tax bracket, every dollar you deduct will save you about 37 cents in taxes. Pretty simple, pretty straightforward. However, in 2026, some big changes arise. There is now a 0.5% adjusted gross income floor. I will explain to you what that means in a second. There's also a 35% maximum benefit cap. I'll also explain that, but I think the best way to do that is with an example. So I'm going to give you some numbers. We're going to take a single taxpayer who has $300,000 in adjusted gross income, and she wants to donate $50,000 in 2026. What happens? First, we take that 0.5% floor. So 0.5% of $300,000 is $1,500. The floor means that any amount that she gives to charity below that amount doesn't count. It's pretty much invisible. So say she gives $500. Nope, nothing. No deduction, even if she itemizes. Let's say she gives the full $1,500 to charity, or she gives $1,000. None of that counts. It's just invisible. Anything under that floor amount, you don't get credit for. Only the amount above that. So in this case, she wants to give $50,000. We subtract her floor, that leaves $48,500 left that she can deduct on her tax return. But then again, we also look at her rate. So for her, she's actually in the 35% tax bracket. So the value of her deductions, every dollar that she deducts, she saves 35 cents. So when we do the math on that, she's going to save just over $16,000 in tax. Before we keep going, I want to address a big myth around charitable donations. So a charitable donation gives you a deduction which lowers your tax bill, but the amount you save in taxes is never more than the gift itself. So charitable giving is generous, but it's not profitable. Think of the tax break as like a sweetener that encourages you to give. If this person we were talking about didn't donate anything and just paid income taxes on that $50,000, they would have walked away with just over $33,000 that they get to keep and spend on whatever they want. What the tax break does is if you do the donation, then your charity receives $50,000, but since you don't pay tax on this $50,000, it only really actually cost you $33,000 to make a $50,000 gift. So essentially, these tax breaks just make it less expensive to give to charity, but you're still giving away money. You have less than you did if you didn't do a donation. Now that you understand that, I want to talk about an interesting way that the cap comes in. So, your income size matters based on how much value of a deduction you're going to get. So, let's do this same $50,000 gift, but this time the donor, the person giving away money, has $3 million in adjusted gross income. So now their floor is way higher, right? 0.5% of 3 million is 15,000. So it's the same thing as last time. If they gave 10 grand to a charity, they get no deduction at all. Nothing counts that's under 15 grand. So of the 50 grand they gave, only 35 grand of that counts. So they only get a $35,000 deduction. On top of that, the cap comes into play too. Under old rules, for every dollar of deduction you get, you save 37 cents in taxes if you're in the highest 37% tax bracket. But for this person, they only save 35 cents for every dollar they get in deductions because there's a 35% cap. So the higher your income, the less impact each dollar of giving has on your taxes. Let's talk about a way to supercharge your charitable giving. One way to do this is to donate property that has appreciated a lot, which means that you bought it for not very much and now it's worth a ton. This is a great way to supercharge your charitable giving because when you do this, you get to deduct the full fair market value of the gift that you gave, and you don't have to pay capital gains on the donation. So it's a double benefit. Let's say Sam has $600,000 in adjusted gross income, and he donates $150,000 worth of stock that he bought for only 20 grand. After his floor, he gets a $147,000 deduction, and he avoids 30 grand in capital gains taxes. So his out-of-pocket cost for giving $150,000 to his favorite charity, it only cost him $67,000 once you crunch all those numbers. However, remember the same rules apply. If Sam had not made the donation and decided to just sell his stock, he got $150,000 for it, he paid capital gains on it, then after tax, he would have kept around $119,000. So from a pure number crunching perspective, he's not richer at the end of this tax strategy because he gave to charity. What happened was he was able to give a lot to charity, and it didn't cost him near as much as it would have if he had given to charity using after-tax dollars. Next, let's talk about a powerful strategy for retirees. If you are 70 and a half, I don't know why they had to make it a half there, but if you're 70 and a half, who does halves? Unless you're like 6 years old or 2 years old, like I'm 2.5. It really doesn't matter, but whatever. I guess the IRS wants to keep things interesting, but essentially if you're 70 and a half or older, you can give directly from your IRA to a charity up to $100,000 per year. And if you do this, this counts toward your required minimum distributions amount. The conventional advice out there is put a ton of money in these tax vehicles like your 401k and your IRA during your working life. And the idea, the old school advice, is that when you retire, you'll be in a lower tax bracket and you'll pay less, essentially. But what I'm seeing, especially with a lot of law firm owners like myself, is that either we continue earning income well into retirement, we like working, we love what we do, or we're financially savvy, so we're having income from other sources, whether that's real estate investments, etc. So we never really drop into a lower tax bracket. Or I have clients who actually do retire, but they saved so much that they have huge required minimum distributions out of their retirement accounts. They have pensions, they have life insurance payments, and they end up in a very high tax bracket because they're receiving all of this taxable income from the various vehicles they set up during their working life. For those of you who don't know, you can't just let money sit in an IRA or a 401k unless it's a Roth, which is a different story. I'm not going to go into that today. But a traditional IRA, you cannot let money just sit and cook in there indefinitely. When you hit a certain age, the rules require that you have to start pulling money out of it. And there's minimum amounts that you have to pull out. Whether you need the money or want the money or not, you have to pull that money out. And when you do, that money is taxable. So if this is an issue that you think may come up for you, come talk to me and we can make a plan that makes sense for your life and your goals and your income level when you reach retirement. But back to charitable contributions. So the cool thing about the strategy I'm about to talk about now is if you donate, there's a rule that says if you donate money to a charity directly from your IRA to the charity, so you don't take it out and give it to yourself first, it goes directly, then this money is not considered taxable income. It counts towards your RMDs, your required minimum distributions, and you don't have to itemize to do this. So this is pretty cool. If you have plans to give to charity and you're going to give to charity anyhow, this is the way to do it if you're a retiree, because your money is getting stretched further. However, before we get too carried away with this, you will still have less money than if you didn't give to charity. What we're doing with this strategy is, again, helping your money go further. So say you had $100,000, like we're talking about in RMDs, and you want to give $50,000 to charity. So let's say you're at a 24% tax bracket, then the tax on that would be $24,000. So the cash in your pocket left after tax is $76,000. If you do nothing from this point on, you just get to keep that. So if your goal from a numbers perspective is to finish rich and have the most amount of money, then you don't do a donation at all, you just keep the $76,000. If your goal is to give the most to charity in a way that's not as expensive to you, then you would give the money directly from your IRA to the charity, and when the dust settles, you'll have $38,000 left to keep. What we're avoiding in this strategy is the scenario where you take the RMD, you pay tax on it, and then you still give $50,000. Because in that scenario, you only get to keep $26,000 after you do your donation. So the strategy helps you give the amount you want to give while making it less expensive for you to do so. I've hit you with a lot of numbers so far, so go ahead, take a deep breath, pat yourself on the back for surviving this far, and stretch, break, shake it off. We're moving out of the world of individuals into the world of business. Most of the law firm owners that I serve and do tax plans for are not C corporations. They are pass-through S corporations. So for S corporations, the donations that you make through your business pass through directly to you as a shareholder. And you only benefit from these donations if you itemize on your personal return. The effect of this is it really doesn't matter from a tax perspective whether you give to charity as an individual or if you give through your business. If you are a pass-through entity like an S corporation, it really doesn't matter from a tax perspective. Do whatever you want to do. So to wrap this whole thing up and tie it with a beautiful bow, when you're thinking about charitable giving, you're not thinking about how to come out ahead somehow, and you don't need some crazy loophole strategy, whatever people are selling people these days. The question you're asking is, how do I stretch my dollars the furthest so that I can make the most impact to the charities I care about at the least cost to me? You want to stretch the value of every gift. You want to give, when possible, pre-tax dollars instead of after-tax dollars. If charitable giving is on your mind or tax strategy in general, feel free to schedule a consultation with me on my website, meganrobin.com. This content is for informational purposes only and does not constitute legal, tax, financial, or investment advice.